4 days after the largest IPO in history, SpaceX stock fell 31%. $620 billion gone in 4 trading sessions. But here's what's interesting. The rockets didn't fail. Starlink didn't lose subscribers. No earnings report came out. No scandal. No product failure. The business didn't change. So what did? That's what this video investigates. Not one answer. 3 questions the market is now being forced to price. Questions that were always in the data. Questions the S-1 showed but didn't resolve. In our last video, we read SpaceX's S-1 line by line. What we found? The rockets, the thing everyone associates with SpaceX, generated 22% of revenue in 2025. Starlink generated 61%. The rocket business produced $653 million in EBITDA. Starlink produced $7.2 billion. 11 times more, with a 63% margin. The thesis? The rockets are the infrastructure. Starlink is the economy built on top. That thesis hasn't changed. But the market is now asking 3 questions the S-1 didn't fully answer. The first question is about growth. The second is about cash. The third is about expectations. Let's go through them. Think of Starlink like a hotel chain expanding globally. The original properties, in wealthy markets, charge premium rates. As the chain grows into new regions, the rates come down. More rooms, lower price per room. The question is whether total revenue grows faster than the average rate falls. For Starlink, the numbers look like this. Average revenue per subscriber per month. 2023, $99. 2024, $91. 2025, $81. Q1 2026, $66. A 33% decline in 3 years. In our last video, we explained why this wasn't necessarily a problem. Volume compensated. Revenue nearly tripled while ARPU fell. But the market is now asking a harder version of that question. To justify the current valuation, Starlink needs to grow from 10 million subscribers to potentially 100 million or more, while continuing to expand into markets where prices are lower. The math works. Until the growth rate slows. And nobody knows when that happens. The first question is not a verdict. It is the variable that every serious investor needs to watch every single quarter. Imagine you own a restaurant that makes excellent food. The kitchen is profitable. The dining room is packed every night. But every year, you're taking on more debt to open new locations, build a hotel next door, and acquire the coffee chain down the street. At some point, the people funding you start asking, when does all of this investment actually return cash? That is the question the market is asking SpaceX right now. Free cash flow. 2023, positive $0.1 billion. 2024, negative $5.4 billion. 2025, negative $13.9 billion. In our last video, we showed that the burn wasn't coming from Starlink. Space and Starlink together were nearly self-funding. The cash was being consumed by the AI segment, $12.7 billion in data center investment in 2025 alone. Then, days after the IPO, 2 things happened. On June 16th, 4 days after listing, SpaceX announced it was acquiring Cursor, an AI coding startup, for $60 billion in stock, implying meaningful dilution for IPO shareholders. Then, on June 22nd, SpaceX announced a bond offering. Demand came in at $89 billion. The deal was priced at $25 billion. In connection with that bond filing, SpaceX disclosed it held approximately $100.8 billion in cash as of June 19th, a figure that includes IPO proceeds and reflects existing obligations and planned uses disclosed in the filing. Evercore ISI projects SpaceX's capital expenditures will rise from roughly $20 billion in 2025 to over $700 billion by 2031. If that projection is accurate, this implies a long-duration capital allocation cycle heavily weighted toward AI-related investment. And there is one detail that received almost no coverage. Before the IPO, there was a broad reshuffling at xAI. Co-founders and senior engineers departed. Cursor was brought in partly to accelerate Grok's development in the areas where the team had weakened. The AI segment lost $6.4 billion in operating losses in 2025, and the acquisition announced to strengthen it cost $60 billion in stock, before shareholders saw a single quarterly earnings report as a public company. The market is beginning to question the timing and magnitude of capital returns. That is the second question. The third question is the most important and the least covered. What if the market isn't questioning the business at all? What if it's questioning the price? Think of valuation like an orchard. You plant the trees knowing the harvest is years away. The question isn't whether the trees are real, it's whether the price you paid for the land was reasonable given how long you'll have to wait. At the IPO price alone, SpaceX was already trading at roughly 100 times trailing revenue. At the peak 4 days later, that multiple approached 160, on a company that posted a net loss of nearly $5 billion in 2025. The range of analyst price targets tells you everything about the uncertainty. Morningstar, $62. CFRA, $115. NewStreet Research, the most bullish of the major firms, $165. And they said the thesis requires looking out over a 20 to 25 year time frame. 20 to 25 years. That is a generational time horizon. And there is a structural risk that most coverage is not discussing. Today, the vast majority of SpaceX shares remain locked up. Only about 4% are available to trade. The first significant unlock window opens in August 2026, the same month as the first earnings report as a public company on August 6th. The main lockup expires in December 2026. When that supply enters a market with a 4% float, the same mechanism that took the stock from 135 to 225 in 3 days can work in the opposite direction. The price of uncertainty changed. The business didn't. 3 questions. Growth. ARPU declining 33% in 3 years, with the subscriber base still needing to multiply many times over to justify the valuation. Cash. Free cash flow deeply negative, an AI division that lost $6.4 billion in operating losses last year, a $60 billion acquisition announced before the first earnings report, and a projected capital expenditure cycle that extends well into the next decade. Expectations. A stock priced for a generational time horizon, with the vast majority of shares still locked up and the first real test arriving in August. The Starlink thesis hasn't changed. 63% margin, 164 countries, the only satellite internet network with global scale in its own rockets. In our last video, the question was, are you looking at the right company? Now the question is different. The business didn't change. The price of uncertainty did. And the question every investor needs to answer for themselves is this: are you paying for the business or for the bet? Because at this price, you are buying both, and only one of them has a 63% margin.